Yeah. So maybe if you look at it, you would have heard so many budget related webinars also post 23rd of July. And while there are various topics which we can touch upon, but today's focus will be mainly on uh, how it impacts non-residents. If you're making pay, that's for the non-resident taxation, how it impacts all Indian companies making payments to non-residents. And the third thing, which you all is important for all of us, is also the VSV scheme, which was there earlier also in 2020. Now they have reintroduced in 2024. So how do you ensure, or if you want to go and opt for the schemes, uh, what are the nuances of the schemes? What is there in public domain at this point of time? Uh, Hello. Somebody saying audio is not working. Just wanted to reconfirm whether it's fine. Sannidhi, can you hear me?
Yeah, I can hear you clearly.
Yeah, so maybe somebody has an issue. Okay. So we will also touch upon the VSV scheme. When do you opt for scheme, and what are the situations in which you can opt for the scheme, which will be beneficial? And certainly it's a good dispute resolution measure, a welcome step to resolve more than there are almost 6.5 lakhs appeals which are pending. And the government, huge amount of money is also stuck from the government side in various disputes. And that is why even government wants to unlock the money, collect certain demands, and that is why this scheme has been brought about. So let's move to the next slide, and how we'll do it in next 45-50 minutes. And then, if required, we can have a question of 5-10 minutes. We will, Sannidhi will take us through the provisions, and then I'll chip in on where do we see an impact and how does it practically impact you by way of examples and experiences which you can share. So over to you, Sannidhi, to start.
Thank you, Jimit. And good evening to all of you. So moving on to the first amendment that we would like to go touch upon is a welcome amendment. It's on the reduction of the corporate tax rate for foreign companies. So earlier, prior to the budget, the corporate tax rate applicable to foreign companies was 40%. When we add surcharge and cess over it, the effective tax rate goes up to 43.68%. In a welcome move, this rate has been reduced to 35%. By adding surcharge and cess, it would be 38.22%. So what we have done is we have put in an example over here that what we can do is we can compare the existing rate, which is applicable to subsidiaries of foreign company, to which domestic tax rate applies, and branches of the foreign company to which the corporate rate, tax rate for the foreign company applies. So when we look at the first example over here, let's say there is a subsidiary of a French company in India, and it is earning an income of 100 rupees. On that 100 rupees, it will have to pay tax of 25 rupees as per the domestic tax rate. The balance amount it will repatriate to its foreign parent, whereas where there is a treaty benefit, it can claim the lower rate as per the treaty, which will be 10%. And accordingly, the total tax outflow for this subsidiary would be 32.65%. If I go to a branch of a foreign company directly in India, okay, that in that case, the income of 100 rupees will be taxed at a rate of 35% plus surcharge and cess, which is 38.22%. On repatriation of such profits, there will be no further tax. So the effective tax would be 38.22%. So if I compare branch versus subsidiary under the new provision where there is a treaty benefit available, the subsidiary effective tax rate is much lower. This was so prior to the amendment as well, because prior to the amendment, the tax for the branches was 43.68%. Now let's compare the case where there is no treaty benefit. Now a company earning the same amount of income, paying the same taxes in India, when it is repatriating the funds back to its parent, it will incur taxes at the rate of 21.84% on dividend, in which case the effective tax would be 41%. So because of the reduction in the tax rate from 43 to 38%, now in this case, my subsidiary is becoming more tax costly. So if I have to give a brief summary, if I have subsidiary and branch both, where there is a country which India has a treaty, in that case, the subsidiary was previously also beneficial and it is now also beneficial. But in case where there is no treaty, or where the company is not eligible to claim the treaty benefit, in that case, now having a branch becomes more tax efficient because of the reduction in the tax rate. So ultimately, what happens is that all income of a foreign company, whether be it income from business, be it income from other sources, even capital gain tax rate where there is no specified rate available, all of those income is now taxed at a lower rate over here. So this is a welcome move. The next slide, we would talk upon the VSV scheme. Now, what is the VSV scheme? Well, Jimit touched upon a little in the introduction part. It is basically a dispute resolution scheme. The government had come up with a fixed agenda saying that we see that there is a lot of ongoing litigation which is pending, and we want to close it as soon as possible. Also, the VSV scheme, which was introduced in 2020, was a very successful scheme for the government in terms of the tax collections. So there's a dual benefit. The government can clear the backlog of the cases as well as improve the tax outflow in the current year by introducing the scheme. So what does the scheme say per se? That if prior to 22nd of July, when the budget was announced, if any appeal is pending for any of the assessee, then you can go for this scheme. And what is the benefit that you're getting in this? If there is the tax dispute where the disputed amount is with respect to the tax, interest, and penalty, the government is giving a benefit that it is waiving of the entire interest and penalty. You will only have to pay the tax amount and be done away with it. So while this is the benefit, what you will also have to look out for is that not all the cases are covered. They are specifically given some list that where your assessment is initiated because of some search, where any prosecution has been initiated, or the proceeding is with respect to any asset located outside India or any undisclosed income. In those cases, you cannot go for VSV. You will have to fight it out in the court. But in all the other cases, wherever you have appeals pending before the CIT, ITAT, High Court, even Supreme Court, you can go for VSV. The government has also come up with a fixed amount of tax that you are required to pay under the VSV scheme. If your disputed amount is with respect to tax, interest, and penalty, like I said, you only have to pay that 100% of the tax amount and none of the interest and penalty. If the dispute is only with respect to interest and penalty, then you only have to pay 25% of the disputed amount and balance 75% is waived off. The government has also given benefit to cases which are prior to the year 2020 when the old VSV was introduced. So the government is saying that even in the prior VSV, if you didn't go, you're still being given another chance. You go for the VSV now. Only catch is that you have to pay 10% of the additional liability what was earlier discussed. The timeline over here given is 31st of December, that if you pay the taxes by 31st December, this is the liability that you have to incur. If you pay after 31st December, additional 10% also you have to incur. Secondly, where the case appeal has been filed by the department, or in case where a favorable order of a higher court has been given in your own case in some other assessment year, in that case, you can close the case by paying only 50% of the amount which is given in the above table. So again, that there is a benefit over here. So while we are evaluating our case, we should have a look at whether any favorable decisions are there for our own case in some other assessment years or no. This is just a numerical example which we have given. So let's say my tax...
Before proceed, Sannidhi, just one important point to note in the earlier thing. If there are any refunds which are due to you on VSV scheme, because of VSV, even possibly you settle their amount and refunds, then that would also be basically granted to you, but without any interest. Okay, that's the only point. And
Right.
just on this slide, while we'll send across the presentation, there is a typo in 22. It is instead of 20, 10 has been deleted. We'll rectify it when the presentation is set. Sorry, continue, Sannidhi.
Yeah. So in this illustration, let's presume that the disputed tax amount is 10 lakh rupees. The interest on that is 8,40,000 and the penalty on that amount is 100% of the tax, which is again 10 lakh rupees. So let's say if the dispute is with respect to all three and my disputed total amount is 28,40,000, if you go for the VSV, then in that case, you only have to pay 100% of the disputed tax, 10 lakh rupees, and you don't have to pay 18,40,000 of interest and penalty, basically giving you a saving of 65% of your liability. Let's say your dispute is only with respect to interest and penalty. So my dispute is 8 lakh 40 and 10 lakh rupees, total 18 lakh 40 rupees. Out of this 18 lakh 40 rupees, the government is telling me to only pay 25% and balance 75% is waived off. So the tax savings that we do is substantial over here. So this becomes a very good incentive for the taxpayers who want to opt for the scheme to close out the matters. One is that the matter gets closed out early. Second is you get those substantial savings for you. Over here, we have just chalked out that what is the process for which we have to go for the scheme. One is that while the fine print of the scheme has not yet come, we are expecting the same to come once the final act is passed, probably within, let's say, a month or so. During this month, what the assessee should do is you look at all your past cases, and wherever it is possible to go for VSV, we list down those cases and we build up our base for whether we can technically argue or we just want to pay off the amount and close the matter. Once the fine print is introduced, we do the formalities of filing the applicable form. We make the payment by 31st of December to save on that additional 10% cost. And once the final order is passed, it is important to get that form 5, which is the final order. If that form is not taken, then it means that your appeal is not yet closed. So in the last VSC, practically some assessees have faced issues in getting that particular order. It is extremely important to get it. Otherwise, your appeal will still remain open with the appellate authorities. There are some key considerations which you should look at. Jimit, if you could come in over here.
So some of the key considerations when you go for this scheme is, first of all, when you go for the scheme, there could be various rectifications which are pending before the officer. So you should also ensure that before you go for the scheme, you ensure that the scheme rectification orders are getting passed before you go for the scheme. Speak to the officer, you'll have a dialogue with the officer, and our experience in the past suggests that the officers are more than willing to first go under 154, rectify and get to the right demand, and then they will then you can opt for VSV, so that because under VSV you go to the original demand under 143.3. So it is very critical that your order under 143.3 is done. Secondary adjustment looks like possibly yes, which could be there under VSV 1 also. Secondary adjustment was there. So possibly there could be a secondary adjustment. Second, yes, can you go for a loss to loss cases? You can also go for a loss to loss cases, although there is no cash outflow, but certainly your carry forward losses gets reduced unless they come out in a different scheme in a different manner. This should be permissible, which was permissible in earlier scheme as well. Can you opt for few grounds only? So if you have say 5 grounds before an appeal, can you say, oh, 2 are in favor, I believe two are dicey case, I would like to go only for 2 of the grounds. And at least in the last scheme, it wasn't permissible. Either you go for all the 5 grounds or you don't go for it. For the same year, if there are 2 appeals, you can certainly go for 1 appeal, like for example, 1 under 143.1, 1 under 143. You can go for either of the appeals, but if you're in one appeal, if you have 5 grounds, you cannot opt for 2 grounds or 3 grounds. You'll have to go for all the 5 grounds. Payment of scheme, will it amount to acceptance of tax position? The answer is clearly no, which they have clearly mentioned that it does not mean that you have conceded your ground. In the future years, also, if you have not opted for scheme, you got for VSP only under 1 year, it is absolutely okay. That doesn't mean that it will be treated as precedent against you or in favor of you in the next year. And certainly met credit also, as per the scheme, you should get it. So certainly, if we go to the next slide, this scheme is certainly worth looking for. And what we have given is what are the apt cases you should ideally go for it. Certainly where you believe the cost is overrun, where there are disputes, where there are weak merits of the case in before the High Court or Supreme Court. Many a times you file appeals because of various reasons that today just to safeguard your penalty. So in which case you can think about it. There are certain decisions where MF and Supreme Court decision has come up. So you may want to think about it whether you would have certainly paid taxes and possibly tax officer would have initiated penalty proceedings and possibly even levied. In such scenario also you can think about going for a VSV thing. There are so many other Supreme Court decisions which has come, which is in the case of telecom, charitable trust, wherever you believe, because of which there could be an impact in your case, you may go for a VSV and at least just pay the tax amount and not interest and penalty. See, if you consider technically, if your case is of 2014, 15, 15, 16, your interest would be almost double. Now, if you go and make your payment in 2004, 5, so that will be a significant amount of interest. So you may want to think about this before we proceed. If we go to the next.
Yeah, this is it.
We have of course discussed what are the apt cases, but if you go to the next slide. Okay. And maybe Sannidhi, if you'd like to discuss the capital gain amendments. Just one thing before the scheme, you please evaluate your case very carefully. Certainly, just government has given you a second chance to go for this VSV. So certainly might as well use this opportunity to go for a VSV. There are a couple of questions which are there in the chat box, which we will answer before we proceed, because that's on VSV. Somebody has written, so first question, whether VSV include consequential NCC in case of a search? At this point of time, it is just mentioned where the reassessment is happening pursuant to a search, then you cannot go for it. Today, if your notice for reassessment mentions that it is pursuant to a search of the other NSEs, then technically it will be unlikely that you can opt for a VSV. We'll see for the detailed scheme to be out, but prima facie, if your assessment notice clearly mentions that it is pursuant to a search and that is why the case was reopened, then it looks doubtful whether you can go for a VSV. Second thing, somebody saying if the appeal under VSV 2020 is still lying with ITAT, I presume when you say appeal under VSV 2020 means prior to 2020 is lying at ITAT. If your appeal was prior to 31st March 2020, your liability will be 110% because you're getting a second chance. If it is after 2020, that's your first chance, and that is why your tax rate is 100%. There is one more question in the chat. At least I had read. I don't know. Okay, I think so that question got deleted or withdrawn by the person. So we can move ahead.
Okay. The next big changes with respect to the capital gain structure. The government has completely revamped the capital gain structure. Number one, the changes with respect to the period of holding. Earlier, prior to the budget, the period of holdings were 3. One is 12 months, 24 months, and 36 months, depending on the type of capital asset. Now they have said that there will be only two period of holdings. One is 12 months, which is for all the listed securities and equity-oriented mutual funds. And 24 months is for all the other capital assets. So which capital assets are majorly impacted? One is that the unit holders for REIT and InvIT, earlier the period of holding was 36 months. Now they have been bought in par with listed equity shares, which is 12 months. Unlisted bonds, debentures, as well as gold, the period of holding has been reduced from 36% to 24 months. For gold, while this is okay, but for unlisted bonds and debenture, whether reducing this from 36 to 24 months really has an impact or no, we'll come to it in another amendment, which is coming in the next slide. Lastly, with respect to the definition of undertaking, for slump sale transaction, the budget has been silent. Earlier, the period was 36 months. Since there is nothing given in this budget for this undertaking, we presume that it is going to remain 36%. If the government intends to reduce the period of holding for undertaking as well, we believe that once the final act is passed, they will bring in a clarification. Second big amendment is with respect to the rate of the capital gains. Long-term capital gains, which was prior to the amendment, 10 and 20% basis the type of asset and whether it's a resident, non-resident, it has been streamlined. Now there is only one rate for long-term capital gains, which is 12.5%. For short-term capital gains, the only change is with respect to listed securities, which has increased from 15% to 20%. For all the other capital assets where there's a short-term capital gain, the tax rate remains as applicable slab rate or the corporate tax rate, whichever is applicable. However, because for foreign companies, the rate has been reduced from 40 to 35%. for those foreign companies, the short-term capital gain tax has effectively been reduced to 35%. Now, what is the impact for listed securities? Listed securities for long-term capital gains earlier was 10% under Section 112A, which has now been increased to 12.5%. So there's an increase. Same with listed securities for short-term capital gains as well, increased from 15% to 20% post the budget. So here there is an increase. For non-resident investors who had invested in unlisted securities, there was an option under Section 112 subsection 1C3, wherein 10% rate was given without the foreign exchange fluctuation. However, that rate has now been increased to 12.5%, but foreign exchange fluctuation shall be given to the non-residents. And lastly, for long-term capital gains for all the other assets, which was 20% with indexation benefit, now the rate has reduced to 12.5% without the indexation. The concept of indexation has completely been removed. So here what we have done in the next slide is that we have given an example for this particular item where we see what is the fluctuation, what is the benefit that we get because we are getting the foreign exchange fluctuation. Let's say that the purchase amount by the non-resident was USD 5 rupees, $5, and the sale amount is in INR 800. Prior to the amendment, I would tax this amount, sales consideration as 800. The cost would be converted to INR basis the exchange rate applicable on the acquisition date, and I would pay tax on it at the rate of 10.92%. Now let's say where I go to the post-amendment rate. I get a benefit of the foreign exchange fluctuation, while my rate is increased to 12.5% plus surcharge and cess over here. But because of the foreign exchange fluctuation that I'm getting, I don't pay a substantially higher amount of capital gain tax. So that is something that we need to take care of when we are now computing the capital gains for non-resident, that we need to take benefit of the foreign exchange fluctuation. This is the amendment which I was talking about with respect to unlisted bonds and debentures. While the criteria for period of holding has been reduced from 36 months to 24 months, what they have done is that they have said that it will be deemed to be a short-term capital asset irrespective of the period of holding. So while it has been reduced, the benefit that we were getting because of a long-term capital asset, that we will now not get. So whatever is the period of holding, 3 years, 4 years, 5 years, unlisted bonds, debentures, as well as debt-oriented mutual funds will always be termed as short-term. So impact for this, Jimit, if you would like to.
Basically all of your CCD, so if your companies or your clients' companies, everybody has investments in CCDs, OCDs, this will get impacted. So you need to look at those treaties, those instruments, whether that's the right structure to invest into. Possibly you may also want to think whether you would like to convert that compulsory convertible debentures into shares and then sell off that shares rather than just transferring the OCDs or anything. If there is, of course, redemption at a premium, then this gets impacted more because that will be capital gains, which will be taxed at a higher rate. And, in case of earn-out structures, you need to see whether that needs to be revisited or not. And, as I said, conversion into debentures into equity possibly is a not taxable transfer. So you may also evaluate that structure. So net, in a summary, you will have to actually evaluate your funding structure and then going forward and then decide the course of action. You can move forward, Sannidhi.
Here we have just given a comparative analysis of the rates which were existing prior to the amendment, which is in red in each and every row, and the rate which is now applicable post the amendment. The major change that we look over here is with respect to short-term capital gains for other than listed equity shares. It has reduced from 43.68% to 38% because of the change in the foreign company rate. Another big change is with respect to unlisted debentures and bonds, because now they are deemed to be short-term capital assets. It will be taxed at 38%, whereas earlier they were taxed only at 10.92%. Another big change over here with respect to other assets where you used to get indexation benefit and used to pay the taxes at 20%. Now, without the indexation benefit, the tax will have to be paid at 13.65%. Now, what is beneficial or no, it will really depend on when the asset was purchased, at what cost it has been purchased, and how much appreciation has been provided with respect to the sales consideration. So it may differ on case-to-case basis, but it is applicable from 23rd of July onwards. So as such, there is no option, but we may just look at the tax which is applicable in our case now. Next is the amendment for the buyback taxation. So how was buyback taxed prior to the amendment? What was the buyback provision saying? That where any shares are bought back, the company who is buying back the shares is required to pay tax at the rate of 20% plus surcharge and cess, which comes to 23.3%. Now, since the company has paid the tax on it, that income in hands of the shareholder is completely exempt. Additionally, the 23.3% tax is to be paid only on the distributed amount. Distributed income means the amount which the company is paying less the cost of acquisition in hands of the shareholders. So deduction was given for the cost of acquisition as well, and only on the net amount the company was required to pay tax. Now, what is the amendment? The budget says that this entire income will not be taxed in hands of the company. It will only be taxed in hands of the shareholder. That too, it will be taxed as deemed dividend. Why deemed dividend? Because you will not get deduction for the cost. The entire gross income which the company is paying to the shareholder will be taxed in hands of the shareholder as income from other sources, and it will be taxed at whatever rate the shareholder is getting taxed. So for example, if it's an individual who's the shareholder, they will have to tax it as per the slab rate. So instead of prior 20% flat rate, if a person who has income slab of more than 30% plus surcharge and all, they will effectively pay a higher tax. Secondly, what happens to the cost? Does the cost go away? The government said, no, you will get benefit of the cost, but you will treat that cost as capital loss and you will be able to carry it forward and set off. So that is how you can do it. Now, let's say you don't have any other capital gains in the future or in the current year, then as such, this capital loss goes waste for you. Secondly, they've also said that while the company does not have to pay tax on it, there will be TDS implications imposed. So for resident shareholders, the TDS would be 10%. And for the non-resident shareholders, the TDS would be whatever is the applicable tax rate for the non-resident. Important point to note over here is that this provision is coming with effect from 1st of October 2024. So we are still left with 2 months before which this provision is enacted. Now, this is a time frame which is available for companies who now wish to do buyback. So we need to see for what sort of cases where the old provisions were more beneficial rather than the new provisions. So for example, like we discussed, that individuals or even partnerships who are taxed at a higher rate, higher than 20%, for them, if the buyback is done post the amendment, then the tax would be higher. If we do it before the 1st of October, then the company can pay the tax at 20% and the income can be exempt in hands of the shareholder. Secondly, for non-residents, where they can claim treaty benefit. Again, over there, we'll have to see whether you want to do it right now or you want to do it post the amendment. Also, in cases where the cost was very significant, because the company used to get deduction of the cost and only the tax was paid on the net amount, where such cases where there is a substantial cost, you may want to get the buyback done before the 1st of October to claim that benefit.
But certainly you may want to also, you will have to also waive out. You may not want to do it before 1st or after 1st. You will have to see, first of all, under the treaty also, whether it is capital gains or dividends. That will is another controversy, whether it is actually dividend or only by capital gains. For a domestic, certainly it makes sense prior to 1st October if you are doing an immediate buyback of shares, because there certainly there will be a savings. But post 1st October, that will not be applicable. But as far as non-residents are concerned, possibly you may want to waive, because you are going to get this loss as a capital loss, possibly a long-term capital loss against your future long-term capital gains. So if you have a long-term capital gains which is there in the same year or the next year, you can of course set off the same against those income earned by the non-residents as well. You can go to the next.
Okay.
Certainly,
next,
if you, whether it is available, the dividend concessional rate is available under the treaty. Of course, yes, if it is treated as dividend, you can of course go for the concessional rate of the dividend, which is there under the treaty. The only thing is very important point to note: many of the treaties are differently worded, and that is why you will have to classify whether it classify. You will have to check whether it classifies as dividend or it classifies as capital gains. Okay. Just one thing, 2 slides before there was one in the table. There was one the rate which was mentioned. There is on the long-term capital gains that we will amend and send it when we send the final deck. That needs to be changed and we'll send it across to you. Yes, Sannidhi.
the next amendment is respect to equalization levy. Equalization levy at the rate of 2% was introduced in the year 2020. And on what sort of income was it taxed? Basically, the government realized that there were many non-resident players who were working in the digital economy. They used to have customers in India without having any physical presence. So if there is no physical presence, they did not constitute any permanent establishment in India. And because of which they landed up paying no taxes in India. So the government realized this, and to plug this loophole, they introduced the concept of equalization levy on online sale of goods and services by e-commerce operators. So what was this tax? They said that on the income which the e-commerce operators get, you have to pay tax at the rate of 2%, and it is only applicable to non-residents who do not have a permanent establishment in India. For the others who already have, they're already paying taxes because of the permanent establishment. Now, in this budget, in a very surprising move, the Honorable Finance Minister completely abolished this concept, and they said that with effect from 1st of August 2024, the equalization levy of 2% will be removed. It is to be noted that equalization levy is also applicable at the rate of 6% on online sale of advertisement. That equalization levy still remains. It has not been abolished. Only the 2% equalization levy on online sale of goods and services has been abolished. Now, what is the impact of this in hands of the non-resident? First is that where there is no equalization levy, does it mean that that income which was previously untaxed will now get taxed in some other provision? Let's say the tax officers try to tax it as royalty. Now for royalty, for online goods and services, online software at least, we have the Supreme Court decision of engineering analysis, which had given us some principles as to how to tax such online software. Maybe litigation in that aspect might increase because the tax department might contend that online software is still taxable as royalty. They could also say that the income which is earned by the non-resident is fees for technical services, in which case the non-resident will have to see whether any make available benefit is available in the treaty, whether there is any human intervention involved, because of which we can come out of the fees for technical services. The tax department may also contend that the income of the non-resident is taxable in India because they have a significant economic presence. Again, because of that, the non-resident may have to see whether any benefit under the tax treaty is available. And wherever such benefits are being taken under the tax treaty, it might increase the compliance burden in India because the non-resident is claiming the tax treaty. So wherever we try to save on the litigation, the compliance burden may increase. That is as a consequence. Thirdly, while this amendment is only targeted towards a non-resident, it could also affect the residents who are making payment to such non-resident. The department could come back to such residents and say that you have to evaluate the taxability in hands of the non-resident and withhold the tax at appropriate rates while making the payment. So again, residents also have to be aware of this provision being removed. Because equalization levy was there earlier, the income of the non-resident was exempt. So even the residents were not required to withhold the tax on it. But in absence of equalization levy, the residents will also have to evaluate whether the income is taxable in hands of the non-resident or no. Thirdly, we'll also have to see that while it has been abolished from 1st of August 2024, the annual reporting for equalization levy, which is Form 1, which is due on 30th June of the next financial year. So for FY 24-25, it would have been due on 30th June 2025. That might still have to be filed because at least till July, the non-resident has been paying equalization levy. One more amendment is with respect to the TDS rate. While the e-commerce operator is making payment to an e-commerce participant, that has been reduced from 1 to 0.1%. And coming to why this concept was abolished, while there was nothing mentioned in the budget speech, there was nothing mentioned in the memorandum as well as to why it has been abolished. But if we look at the international tax environment which is currently going on, we know that there is a concept of pillar 1 and pillar 2, which is for which more than 130 countries globally have signed, which basically aims to tax the companies in the digital market and also ensure that globally all the MNCs pay at least 15%. Now, while many of the countries have already implemented this pillar 1 and pillar 2 in the domestic tax law, it was also expected that India would do it, but in this budget they have not done it. But if it were to implement, then the prerequisite of it was abolishment of equalization levy. So
just to add, prerequisite of pillar 1 was abolition of equivalent, because pillar 1 was going to be introduced for digital thing. Pillar 2 is independent, and that anyway we had anticipated that will be introduced, because that's for all bigger companies which are having a turnover of about 750 million euros, which is around 6,750 crores, where they would have to ensure that wherever they operate, they pay at least 15% tax. So that's pillar 2. And pillar 1 was basically, you pay a tax in your home country, and other countries will basically collect taxes from the home country. And there the prerequisite was that, and this was mainly to tax all the e-commerce operators, because the concept of permanent establishment, which was there for taxing the companies, that wasn't effective in case of e-commerce taxation. And that is why pillar 1 was planning to be introduced. Of course, this has got derailed. So hopefully in the next 6 months, when the government comes out with the budget, or basically the new direct tax code, as the government is saying that in 6 months they are going to revamp the entire code, we do see an anticipation that pillar 1, pillar 2 would be brought in, very likely. And that is why we believe that withdrawal of equalization levy is 6 months prior to then what it could have been withdrawn. But having said which, that's what we have to, it's a good measure as far as non-residents are concerned. But one point to note is they still have to comply with till 31st of July. So it's not that it is withdrawn from retrospective effect. It is withdrawn only from prospective effect, and you will have to still comply with the same. Sorry, Sannidhi. Yeah.
just to add on one point over here, while with respect to pillar 1, in the post-budget speech where the Honorable Finance Minister was asked about the equalization levy, she as well talked about pillar 1 and pillar 2. So this is again an indicative that in the next budget, maybe we might see pillar 1 and pillar 2 being introduced in the domestic law of India. Next is with respect to the angel tax. Now, what is angel tax? Since many years, the Income Tax Act has taxed companies who are issuing equity shares at a premium. So whatever is a fair market value, if the company is issuing shares over and above that fair market value, the premium which the company is getting is taxable in hands of the company. Till last year, this provision was only applicable to residents. In the last budget, they widened the concept and made it applicable to non-resident investors as well. Now, in this budget, they have completely abolished this concept. So companies who are issuing shares at a premium will not have to bear taxes on it. So what does this mean? It means that the valuation for basis which the companies are issuing shares, that valuation will solely be driven by commercial terms, and the companies can issue shares over and above that valuation as well. But does it mean that the valuation does not need to be carried out at all? Answer to that would be no, specifically for non-residents, because the foreign exchange laws of India, it also has a concept of FMV. What does the RBI say? That if you are issuing shares to non-resident, there is a floor price below which you cannot issue shares. So FMV is still required to be computed because of FEMA. However, if you issue shares over and above it, the Income Tax Act will not tax you. So that is one. Secondly, this is a beneficial amendment, obviously, for mainly the startups who are issuing shares at a huge premium. It also affects the convertible instruments where it has been converted to equity shares. Prior to the amendment, there were cases where 56 to 7B, which is this provision, was getting triggered in such convertible instruments as well. However, one more thing which we need to take care of now is that since the companies would be issuing shares at huge premiums, assessment or scrutiny with respect to Section 68 could increase. The department could go after the investors to see what is the source of their income, whether there is any undisclosed income. And if they do find, then the tax for that undisclosed income might go above 60%.
One point note, while technically 68 could not have been applicable to non-resident, but today, the manner in which, practically happens, many a times they go for source to source. And that is why we have seen many cases of 68 getting issued under wherever the shares have been issued at premium. So it's more of a practical thing where we have seen lots of instances of where Section 68 has been invoked wherever the funds have been raised at a premium. So that still needs to be taken care of. And today there will be one of the occasions which is always there while angel tax has gone away. If the premiums and something is really very high without any basis, then certainly the government always has a GAR which they can always invoke if they find that there is something which is done to evade taxes. So that provision is still available always with the government. Next.
And the last is some other amendments which were introduced. One is the reassessment provisions. The timeline for the reassessment has been reduced drastically. There are two kinds of notices which can be issued under reassessment. One is the notice which is issued for the department to find out whether there is any undisclosed income, whether there is any income which has escaped assessment. And other is that once the assessee provides its response, the department has to come up with reasons as to why it does not agree with those reasons and it still believes that there is any income which has escaped. So for both these notices, the timeline has been provided as 3 years and 3 months. And where the income escaped is more than 50 lakh rupees, where the earlier timeline was 10 years, it has been slashed down to only 5 years and 3 months. So the timeline has drastically reduced. The year which it will particularly apply is AY 18-19. Till the budget is passed, the department still has time to issue notices for reassessment for AY 18-19. So till 31st of August, we believe that the department is actively looking at reassessment cases, and we should not be surprised if notices start flowing in bunches. So till 31st, we have to check the portal regularly to ensure that AY 18-19 notices have not yet come. Secondly, this is again a welcome amendment wherein they have said that assessees who are holding foreign assets.
Just before we proceed, on the reassessment, you would have seen last 1 or 2 years, there has been lots and lots of litigation in and around reassessment. So some of the amendments which have been brought in, we have not detailed out because to keep it brief. Many of them have been to override those decisions which, because of so many decisions which has come by various high courts. So some of the amendments have been to override their decision and streamline the process. Of course, reduction of 10 years to 5 years is a very welcome move. But we do see that there will be, again, possibly some other interpretation issues in the reassessment. So be very careful when you receive the 148 notices, always see whether, before going into merits, whether there is technically, is there a way whether reassessment is valid or not, and then go into the merits of the case as well. And as Sannidhi mentioned, there will be notices likely to be issued. It's there in public domain also, various articles that they are likely to issue notices before 31st August for AY 18-19 because that's the last date by which they can issue. So if you are expecting certain notice, don't be surprised. Be ready for the notices in next 15-20 days. Proceed, Sannidhi.
Yeah. The next is a welcome move, wherein assessees who hold foreign assets below a particular limit, which is 20 lakh rupees, even if it is not reported in your income tax return, no penalty will be levied under the Black Money Act and the Imposition of Tax Act. So it's just to give benefit to those small assessees who hold very few small foreign assets. Secondly, again, another welcome amendment is with respect to TDS prosecution. This will affect industry in all the industries. What does it say? That any prosecution will not be initiated if the TDS payment delay is only is rectified before filing the TDS return. So what does it technically mean? That if I have a TDS liability for the month of August, for which the due date is 7th of September, if let's say because of some human error, I could not make the payment by 7th of September and I make the payment by 10th of September. Prior to the amendment, the department had powers to initiate prosecution for even such small delays. And when they initiate the prosecution, the notices directly goes to all the directors of the company. So it becomes a huge issue. The government realized that initiating prosecution for such small matters where there could be genuine errors, there could be human defaults, there could be issues at the bank's end for processing the payment. For those cases, it is not a good thing to initiate prosecution. So what they've done is they've given you time till the date you file the TDS return. So let's say for August, in my example, where the TDS due date is 31st of October. Let's say even if I make the payment by 10th of September or 30th of September or even 31st October, prosecution will not be initiated. Penalty and interest the department can levy. But prosecution for such small
The
delays has been
penalty for
removed.
deducted and deposited is not there. It's interest could department will levy, but no prosecution.
Yeah. So a protection from prosecution has been given if the TDS is paid at least till the TDS return filing date. And the last amendment which we want to cover over here is regarding the FEMA. The government, basically the finance minister in a speech said that we want to enhance foreign investment, we want to encourage it. So that is why they have said that foreign direct investment rules and even overseas direct investment rules will be simplified, they will be changed. While the overseas direct investment rules had been changed only in October of 2022, basis this, they might still come up with simpler processes and simpler timelines. Recently, they also, before the budget, they had already introduced draft regulations for import and export regulation. It is still in the draft stage where they're open to comments. So it gives a flavor that the government is looking at foreign exchange laws as well, apart from the Income Tax Act. So while this is the last amendment that we would like to cover over here, overall, this budget was a power-packed budget. Many new amendments have come in. The government, after the re-election, this was their first budget. They came up with a very clear agenda that they want to simplify the tax structure, even if it results in revamping of the entire tax structure. While some of the amendments are something which would be adverse for many of the assessees, but there are many welcome amendments as well. Jimit, if you'd like to add over here.
Yeah. So net, see, we do see in next 6 months, we are going, it's like a mini budget because next 6 months, you're going to see another budget and very likely it's going to be a huge new code which is likely to set in. So, and which the government has clearly said that we are going to redraft the entire law practically to try to see if it simplifies. Time will only tell whether it will be real simplification or it will be more complex. But we will wait and watch. But if there are any representations and everything, all the companies needs to start representing to the government because they are ready to relook at the law. If they want any amendments to get in or any suggestions they have. Now, and as an overall, it's a very positive budget, I would say. At least the government is still tilted towards spending in the infrastructure side. The economy is going comparatively strong as compared to the world where you see likely that there could be depression or recession in some countries. India is at least on a stable growth path. Of course, you would have expected higher growth, but India at least is growing at a decent percent. The government, if you see, apart from this, has been focused on a lot of employment generated initiatives or incentives as well. So let's hope, we keep moving towards the same direction. And when the act comes in next year, there'll be a little bit more of simplification also. Now, let's answer the questions which are there in the chat box since we have 5 minutes. Somebody has asked for the debt security capital assets on which capital gains were realized, whether holding period. So if it is prior to 23rd July, everything will be 36. After 23rd July, it will be 24 months. As indexation has been taken away in Finance Bill 2024, now CII declared with no significance. CII declared with the significance for assets sold till 23rd of July. After that, it will be practically of no significance because indexation will not be allowed. But till then, it will be certainly of significance prior to 23rd of July. 2024, because even if you sold prior to 23rd of July, the indexation benefit is available. Only after that, it's not available. Reduced rate of taxation available from which date? It's from 1st April 2024, that is financial year 24-25. Here also important point to note, which all companies get impacted? PE, all companies who have a permanent establishment, project office, branch office, and companies who are foreign companies who are claiming presumptive taxation where the income is deemed as 10%, where the rate will reduce from 4.23% to practically 3.8%. So this will impact your lower withholding orders as well. So maybe these were the questions which were there in the Q&A. Any further questions? We'll be happy to answer. There is Varsha who is raised her hand. We have answered her question, but just in case she wants to ask the question. You can unmute yourself and ask the question, Varsha. Okay, I presume there are no further questions which are there because we have answered all the questions in the chat. Okay, somebody has raised us in case of indexation available till 23rd July, tax on LTCJ I have tax at old rate. So everything till 23rd July is old rate. After 23rd July is new rate. Okay. And remember, it's not an option given to you that what is better, one or two. At least as of now, it's not an option, although representations have been made to give an option. We'll come to know today, tomorrow, because the amendments in the finance bill is likely to be presented today, tomorrow. If that option, but as of now, there is no option. You will have to compulsory, if it is after 23rd July, you will not get indexation and you will have to follow the reduced rate. If it is before, then certainly you have that indexation thing which was available to you. Sorry, somebody is asking, will these amendments impact the ICA exams to be conducted in Jan 25? Sorry, I'm not the right person. Whether ICA exams will be on the new budget or the old budget, maybe ICI, the course portion will, will be the right thing, whether they see the latest. If they consider the latest budget, then yes, this will be finance bill 2024 will have to be considered. If that's what is covered in the latest budget, then certainly yes, because in February, practically it was not a full-fledged budget. Yeah. Yes, we will share across this PPT to everyone. There are a couple of changes which we need to make in the presentation, some typo errors. We will make the same and then send it across to Taxmann for sending it across to the participants. No, but we are on the top of the hour. I'm just seeing whether any questions are still there. We don't see. It's 5:59 and then we'll end the session now. Thank you everyone for the patient listening.